The final stretch, fourth quarter market strategy for investors. The calendar has turned, and with it, investors enter the final stretch of the year. The fourth quarter has historically been a period of optimism, volatility, and sometimes surprising reversals. With 2025's remarkable run in equities, S&P 500 up over 13.5% year-to-date, Nasdaq higher by 17%, and the Dow and Russell each gaining close to 9%, the question now is, what should investors expect as we move into Q4, and how should portfolios be positioned? This video takes you through the latest market narratives, covering government shutdown risks, sector rotations, earnings season expectations, the ongoing AI trade, consumer weakness, credit cracks, and more. Drawing from Wall Street panel discussions and independent analysis, we'll build a roadmap for navigating the months ahead. 1. Setting the stage, a strong year so far. Markets have defied skeptics in 2025. Despite fears of persistent inflation, geopolitical tensions, and slowing global growth, equities remain resilient. S&P 500 up plus 13.5% year-to-date, Nasdaq higher by 17%, and the Dow and Russell each gaining close to 9%. The question now is, are stocks priced for perfection heading into year-end? 2. Investor mindset. Should you expect a year-end rally? Market strategists frequently talk about seasonality in Q4. Historically, the last 3 months of the year have tended to bring gains, often driven by strong consumer spending, institutional rebalancing, and holiday optimism. But, as Liz Thomas pointed out during a CNBC discussion, caution is warranted. After all-time highs, a pause or shakeout wouldn't be unusual. Large cap selling pressure is evident. Bank of America's Flow Show highlighted record sales of large caps in the past 2 weeks, third largest since 2008. Sector outflows. Financials have seen 6 straight weeks of outflows. Energy sales hit their highest since early 2022, and communication services outflows rank among the largest on record. This tells us that many institutional investors are locking in profits, anticipating that valuations may need a breather. Still, history suggests the crowd can be right. Goldman Sachs recently raised its global equity forecasts, signaling confidence that earnings strength and AI tailwinds can carry stocks higher. 4. Government shutdown, risk or opportunity. The U.S. government shutdown officially began this week. Roughly 600,000 government workers are affected, raising fears that unemployment could tick higher toward 4.7% if the closure drags on. Short shutdowns, markets typically look past them quickly. Prolonged shutdowns could pressure consumer spending, airline travel, and discretionary sectors. Yet, from a market standpoint, shutdowns often create buy-the-dip opportunities. Investors should remember that political theater rarely has lasting economic impact compared to fundamentals like earnings, inflation, and interest rates. 5. Sector rotations. Where is the money moving? One of the most important signals in Q4 is sector leadership. Healthcare, surprisingly strong, up nearly 4.6% in a week, becoming the top-performing sector alongside utilities and technology. Financials, the weakest sector, with major banks and lenders under pressure. Energy, mixed. Oil prices remain capped by policy pressures, leading some managers to rotate capital into utilities instead. Technology, still the clear leader, especially within semiconductors and the AI Magnificent Seven. This rotation highlights the flight to safety. Investors want exposure to growth themes like AI and semiconductors, but also defensive allocations in healthcare and utilities. 5. The consumer question. Smoke or fire? Perhaps the biggest concern under the surface is the health of the consumer. Several warning signs are flashing. Capital One down 5% this week. Affirm down 15% in a month. Klarna and Upstart facing heavy losses. CarMax down nearly 27% in a month amid rising loan delinquencies. Subprime auto delinquencies up 9.3% in August. This raises the question, is it smoke or fire? Credit markets are starting to notice, but not yet panicking. Credit spreads remain tight, suggesting no systemic alarm. However, if unemployment ticks up due to a prolonged shutdown, or if bankruptcies spread, consumer finance could be a leading indicator of broader stress. 6. The AI engine, too big to fail? The AI trade remains the dominant force in 2025 markets. Consider this. Nvidia just crossed a $4.5 trillion market cap, larger than the entire stock market of every country except the US, China, Japan, and India. Since ChatGPT launched in late 2022, the Mag 7 stocks have ballooned from $7 trillion to $18.6 trillion in value. They now represent 33% of the S&P 500, the highest concentration in modern history. This raises two conflicting truths. AI is real, not hype. Companies like Nvidia, Microsoft, Meta, and Alphabet are deploying real products with revenue impact. And concentration risk is real. If even one or two of these names stumble on earnings, sentiment could shift sharply. For now, the Mag 7 remain impervious to economic weakness. They generate massive cash flows, dominate global markets, and continue innovating. But valuations are stretched, leaving little room for disappointment.
7. Earnings season, tariffs, and consumer splits. As Q3 earnings season begins, investors should pay close attention to tariffs. Companies like Nike face significant headwinds from tariffs. Who absorbs the costs, companies, distributors, or consumers, remains a key question. Consumer bifurcation. Roughly 60% of Americans live paycheck to paycheck. Inflation in groceries and essentials disproportionately hurts this group. Companies catering to them may face challenges. Resilient corporations. The best CEOs adapt, whether through pricing power, supply chain adjustments, or shifting costs. Top companies find ways to protect margins. Expect volatility as companies issue guidance that reflects tariffs, consumer splits, and slowing macro conditions. 8. Credit cracks and private lending risks. While public equities are strong, private credit has begun showing stress. A $10 billion auto parts manufacturer defaulted in private credit markets. A subprime auto lender also went bankrupt. These defaults highlight risks as non-bank lenders filled the gap left by traditional banks. Banks, for all their flaws, have risk management systems. Many new entrants in private credit may not. Investors with private market exposure should monitor risks closely. 9. Energy and utilities, the new growth trade. A fascinating 2025 theme has been the re-rating of utilities and nuclear energy companies. GE Verona, up 82% year-to-date, trading at 60x earnings. Vistra, up 33%, trading at 25x. Constellation Energy, up nearly 50% year-to-date. Oklo, nuclear, up over 400% year-to-date. These companies are being treated like growth stocks, fueled by demand for electricity in the AI era. Data centers, AI inference, and electrification all require massive power supply, creating secular growth tailwinds. The challenge? Valuations are rich. Utilities traditionally trade at discounts, not premiums. Investors piling into these names should size positions carefully and be prepared for volatility if the growth stock narrative reverses. 10. Technicals and market internals. Beyond fundamentals, technical indicators continue to support a bullish trend. S&P 500, SPY, and VOO, bullish weekly and daily charts. NASDAQ, QQQ, remains strong, led by semis and AI. Dow Jones, sideways but stable. Russell 2000, trying to break higher but still lagging. VIX, volatility remains contained, retreating from spikes. International markets also look attractive. Eurostoxx 50, FEZ, is benefiting from stability compared to U.S. shutdown drama, approaching highs not seen since 2007. 11. Stock highlights from Q4 watchlist. Bullish standouts. IBM, breaking higher, fortress balance sheet. Lam Research, LRCX, new all-time highs, riding semiconductor boom. XAR, defense ETF, strong chart, geopolitical tailwinds. Tesla, bullish trend intact near resistance levels. Names under pressure. Capital One, COF, weak consumer finance trends. Delta Airlines, DAL, airline weakness tied to consumer slowdown. Darden Restaurants, DRI, downtrend below cloud support. CarMax, KMX, breaking to new lows on auto loan stress. Meta, weakening after strong year-to-date run, facing valuation tests. Wildcards. Nike, positive earnings surprise, but chart shows caution. Apple, approaching resistance, risk of double top. Palo Alto Networks, PANW, bullish long-term, but resistance overhead. 12. The advisor's perspective. What smart money is doing. The CNBC Financial Advisor 100 recently ranked Parsons Capital as the top firm in the U.S. Their approach highlights valuable lessons. Focus on long-term themes with staying power: AI, IT security, crypto, deregulation. Stick with large-cap leaders that can self-fund and weather volatility. Tailor portfolios to individual client needs, no one-size-fits-all. Their top holdings: Apple, Microsoft, Amazon, JP Morgan, Alphabet, Oracle, IBM, and Berkshire Hathaway. A strong mix of growth and stability. 13. Final trades and takeaways. The investment committee wrapped with some final trade ideas. Netflix, buy the dip opportunity after Elon Musk's social media critique. XAR, defense ETF, strong defense spending supports the theme. Apple, momentum toward new all-time highs. 14. Key investor lessons for Q4. Expect volatility. Shutdown headlines, tariffs, and consumer cracks may create bumps. Stay with strength. AI, semiconductors, and utilities remain core leaders. Beware of concentration risk. Mag 7 are dominant, but carry weight of the market. Watch credit markets. Spreads tightening is reassuring, but any widening could signal deeper trouble. Rotate selectively. Healthcare and defense provide diversification against overexposed tech portfolios. Respect valuations. Utilities at 30 to 60x PE are not normal. Position size accordingly. Remember seasonality. Q4 often favors bulls, but nothing moves in a straight line. Conclusion: navigating the final stretch. As we enter the fourth quarter of 2025, investors face a market both optimistic and fragile. The Mag 7's dominance, AI enthusiasm, and utility re-rating have powered indices higher. Yet, consumer finance stress, private credit cracks, and political drama remind us that risks linger beneath the surface. The playbook for Q4 is simple. Stay invested but balanced. Lean into quality large caps and secular growth themes. Diversify with healthcare, defense, and selective international exposure. Manage risk, not just chase returns. The market is strong, but no rally is without turbulence. By positioning wisely, investors can finish 2025 on solid ground, ready for whatever 2026 brings.